Welcome everyone. We are back with another great video. Very timely video.
Yes,
as
very
we
much.
Get into this, how to maximize your RSP for retirement this tax season.
2025.
We're going to tackle when an RSP makes sense, because it doesn't always make sense. There's only certain areas. We're going to look at how to get the most of it, plus a few additional tips. First, a little bit of knowledge on an RSP.
Yeah, so just to give you that sort of scenario, the deadline for contributing to an RSP for the 2024 tax season, which is what we're going to be dealing with coming up before April, is March 3rd, 2025. So we've got the first 60 days. That's where it's counting in, not counting weekends. So that's why it's the March 3rd date. RSP contribution room, of course, is based on earned income, 18% of your earned income, up to a maximum of $31,560 for 2024. And of course, you can always carry forward room if you want. And where do you go and find this? If you don't know where it is, go to your notice of assessment from the CRA, and it will list exactly what your contribution amount is from there.
There you go. So we have a quick Cole's notes of how much you can contribute, the deadline, those good details. When does an RSP make sense? We'll go through a couple of items or criteria. The big one is going to be high income. Now, high income could be in a few areas, but ideally you contribute money in a high tax bracket, so you get lots of savings at that high tax rate.
Yep.
But remember, an RSP, when you take it out, it is fully taxable. So you want to contribute in a high rate, you want to take it out in a lower rate. So if you're just a high income earner, you're earning a really good paycheck, well, RSP probably makes sense.
Put it in.
Because you're in a high tax bracket, you get all those savings. Or perhaps there's a spike in income. Maybe you sold a property, you sold a cottage, you ended up with a capital gain, your income spikes. Well, that would be a good year to use the RSP. Our rough guideline is we use a marginal tax rate of 30%.
Yes.
So if you're above that, you're getting at least 30 cents on the dollar back in terms of tax for your contribution. Your RSP is probably going to make sense. We have a handy table here, depending on where you live, how much you have to earn to get to that 30% marginal rate.
Yeah, so if you take a look at the table here, this is sort of where those brackets are when you start paying that 30% of combined income that's going forward. So as you can see, most of them have that sort of federal and provincial combined scenario at around that 55,067. But again, when you start getting higher up, if you go into the territories, now you're over 100,000 before you get to 30%, which is phenomenal. And of course, there is the opposite side of the scale where in Nova Scotia, you know, if you're earning just less than 30,000, you then get into that 30% bracket. So it would make sense on any of these numbers. If you have income over that and you're in that province, you should probably do a contribution to the RSP. It's going to make much more sense for you.
Yeah, because that way you're saving 30% tax because your income is going to be in that particular bracket. So we talked about when a contribution makes sense. High income is one of them. Another criteria when it makes sense is you have lots of time until you take the money out.
That's right.
I don't want to put an RSP in now and then take it out next year. Maybe that makes sense, but usually the better bet is if I put it in now and I take it out in 20 years, because now I've got a long time frame for that money to compound, to grow, because once it's in the RSP, you don't actually pay any tax until the withdrawal. So you have many years for it to compound without any tax. So that compounding does not get interrupted. That's usually ideal. So often RSPs, we think of a long time investment opportunity because you need that time frame.
That's right.
For it to really make sense. So if I put it in now and I say I'm in a 30% tax bracket, in the future, I end up still in a 30% tax bracket, but I had 20 years for it to grow and compound. That probably still makes sense.
Yeah, exactly.
Because the time is on my side. So we talked about when it makes sense. How much should you actually contribute?
Well, and that's a big factor. And the lower your tax bracket, of course, there's odds and ends. If you have a tax issue, say you sold a cottage or received a bonus, enough to offset the burden, that, you know, contributing now would be a good idea, because the cottage is going to give you a very big tax bonus, that you are a very big income bonus. Solving those tax problems, a contribution there. Or, you know, if you're going to be able to knock yourself down a tax bracket, that's another one. I mean, that's a big factor in a lot of the times why we make those RSP contributions in the first place. So we take an example, you look at it, John lives in Ontario, he earns $100,000 a year. Well, for 2024 taxes in the province of Ontario, $90,599, that is the limit. If you're over that, up to the 102 plus, it has a marginal tax rate of 31.848%. And if John contributes $9,401, well, his income now is underneath that level. So basically, he's lowering his tax bracket. He's gone from any of that $9,000 being taxed at a certain rate. Now he's underneath. You're looking at a savings of almost $3,000 based on the fact that he's made that RSP contribution.
Yeah, and then that's a great way to think about it. If you can lower one tax bracket, that would be ideal. Of course, it has to make sense from cash flow, right?
That's right.
If you don't have 20 grand to put in to lower the bracket, well, put in what you can. And all this kind of stems from data we're looking at and questions we get for folks. If you have a question, whether it's on RSPs or anything else financial, how do people get a hold of us?
You go to chatwithclintonandkevin.com. We're more than happy to answer any of the questions you have on your RSPs for this year, previous years, or going forward, as well as any other financial matter that you might come up with. By all means, contact us that way. We'll get back to you. It's Clint and I that will receive these, and we'll be the ones answering your questions. No robocallers or anything along those lines. But also, there's another factor we now have on our website at beckerorr.com, and that is
the newsletter. Yeah, and you can go to the website and it'll prompt you if you want to sign up for the newsletter. There's also a link in the description, so you just click that as well. And the newsletter is weekly. If you like these videos, newsletters, tips every single week about financial matters. Also, we do host free webinars on occasion, and we invite the folks on the newsletter list, so that is another prompt for you if you'd like to sign up for the newsletter. We talked about when an RSP makes sense.
That's
We've
right.
talked about how much you should contribute. We'll now talk about some tips to really get the most out of that RSP account. And the first tip has to do with spousal RSP contributions.
Yeah, and basically you can contribute to your spouse's RSP and get the tax deduction and then build the assets in their name. So a lot of the times this happens where one spouse is earning substantially more than the other spouse, and by the time you want to come to retirement, you'd like to have more equal incomes, things along those lines. Well, making a spousal contribution can be a very good way to do that. You are the one making the contribution. Your spouse is the one that's going to get the benefit from it, but you get the tax deduction benefit, which is really what you need, because either you're lowering your tax bracket, you're paying less taxes, whatever the case may be. That gives you that income splitting scenario for the value of the spousal, and it can be helpful, as we've said, large difference in spouses, or if you intend to retire prior to 65, because 65 is basically the way for an RSP to going to a RIF or something along those lines where you can income split. If it's under 65, you have to claim it yourself. So if you both have equal RSPs to draw from, it's a much better situation.
Yeah, so it has to do with your plan, right? If there's a big gap between the incomes of the spouses, a spousal RSP could be quite helpful. Or if you intend to retire before 65, because the income splitting rules only apply after 65.
Yes.
For RSPs, that is, or RIFs. Then the spousal can certainly be helpful. Another tip is the carry deduction forward. You can carry it forward. You can carry it back as well, as long as you do it within that window.
That's right.
60 days into the new year, so 60 days into 2025. So that's before the March 3rd number we mentioned earlier. You can carry that back to your 2024 taxes. You can also carry it forward. So if you put money in the RSP because you have the extra money, but you don't think it's the best time to actually use the deduction,
That's right.
you don't have to use it on your taxes. You can carry it forward. Say, all right, the money's in there, and I'm not going to use it on this tax return. Maybe I'll use it on the next tax return because I think I'm going to get a bonus or a higher income next year. That'd be a better time to do it. But the money's already in the account. It's already invested and growing, and then you can choose when you use the tax. So you can carry it forward. That's another tip. And then the golden plate here, if we will, in terms of tips, is the employer match program.
Yeah, and basically what that usually happens is if you're going to contribute a certain amount, your employer usually matches what that contribution is. Our view is put whatever you can in. It doesn't matter what tax bracket you're in. You're in a 15%, 25%, doesn't matter what it is. If you're going to contribute 5, they're going to add 5, you get a $10,000 contribution. That's a perfect 50% or 100% gain from what you put in. It makes sense. So it doesn't matter your tax bracket, put that one in. That is the simplest way to deal with it.
Yeah, and then another tip is you're putting all this money in, you could get some money back. You
That's
could
right.
get a tax refund after you file the taxes because you have those RSP contributions. Do something with the refund that optimizes your finance. That would be ideal. Invest it, pay down debt, whatever it is. Often, you get a tax refund. It's seen as free money. Oh, it's
It is.
a bonus. It's a windfall. It's just your own money coming back to you. You paid too much tax during the year, and the government says, here's some of that money back.
Yeah.
It's not a bonus. It's not free. It's not like you won the lottery.
It's your money.
Your money coming back. So ideally, you do something with it. And I get the emotional part of it. It's not like a steady paycheck. It's something that comes all at once, and people treat money that comes all at once differently.
They do.
There's a different emotional context there, and that can be difficult. But ideally, if you use it to invest further in a TFSA, a non-registered account, use it to pay down debt, something to push your finances forward, that would be ideal. Or if you're really trying to fight those emotions, say, hey, I want to spend some of this, what I think a windfall, well, you could do a 50-50. All right, I'm going to put half it towards debt, the other half I'm going to spend frivolously on something that's fun. At least there, you're still getting some benefit of that refund. And if you like this video, we talked spousal RSPs a moment ago. We got a whole video that goes into if spousal RSPs make sense and a few nuance and details there. Click on that one. We'll see you again very soon.
Take care.